It's Lon Welsh at Ironton Captial, and today I want to talk about our short-term income fund, or STI. I've got these legal disclaimers I'm required to share with you. Basically, you'll want to consult with your CPA, your attorney, and your financial advisor to help you evaluate how this prospective investment could fit in with all the other investments that you've got. And there's a lot of company-sourced information you'll have from us that you'll want to share with your advisors to help you guide and make a really good decision. So you might be familiar with us from our national diversified funds. That's where we invest money for up to a 5 or 6 year period with a goal of generating about a 17% annualized return. And for the long haul, that's a really fantastic vehicle. But what I heard from you among the investor community is that I need a way to invest, and it's okay if I make less money, but I need to have high liquidity and access to my funds if I need it. And that's why I created the short-term income fund. You can get the money back on a month's notice, usually, oftentimes even less, and it pays about 8 or 9% a year, about 2% per quarter. One really fantastic feature about the short-term income fund is that all of the distributions are treated as REIT income, or real estate investment trust. And for most of you, it will be at the 20% tax rate at the federal level. Even if your marginal income tax rate is 32, 35, 39, something relatively high, for most of you in the really high tax brackets, you're going to get a tax break from this fund because it's taxed as a REIT. Do check with your CPA to figure out the details on this. If you need to have some access to your money, but you don't need to have it be quite that liquid, we have a medium-term income fund, and this fund pays between 11 and 13%. Not a lot of liquidity in the first year, but decent liquidity after that. So we're going to talk about short-term income fund today. So we're focused on serving accredited investors that aren't well served by other wealth managers, particularly in the real estate space. And real estate is mostly what we focus on. So in the overall short-term income fund, about 80% of the capital is allocated to a hard money fund and a bridge financing lender. So they're based primarily in Denver and Salt Lake City, Utah. And the loan to value on the loans they make is around 62%. So they have the investors put a very high down payment, which provides a lot of security for us. And the person borrowing the money has to personally guarantee the loan. So if we got into some sort of disaster situation where the asset was impaired, we couldn't sell it after we foreclosed on it, we would take the guy's house to pay back. So the fund has had over 1,000 loans to date, 25, 30 foreclosures. They've made money on every one of them. They haven't lost money yet. Nothing is ever foolproof, but I feel very good about the way this is structured. That fund is managed by former corporate bankers, and they run this fund exactly like they did when they were at the big, very formal bank. That's about 80% of what we invest in for you. The other 20% is medical accounts receivables, where we provide financing to doctors who have provided care to a patient, and they're waiting for the insurance company to pay them back, and sometimes those waits are very long. We help to accelerate the process. Similarly, we only advance 35 to 40% of the value of the claim, and we cross-collateralize all of the claims in the portfolio. So if you've got a basket of 100 different medical claims, 100 different patients that a doctor served, we would advance money on, say, 90 of the 100, but we'd have a claim on every single one of them. Just in case one of them doesn't work out, we can take a different claim to get paid back. So again, there's always the possibility of losing money somehow, but we feel like it's very, very secure. That's why I've invested a lot of my family's money in this. So we expect that we'll be paying you somewhere between 8 and 9% per year. The more that you invest with us, the higher your rate of return will be. And those distributions are quarterly. And those distributions start in the first quarter that you're invested with us. As I mentioned before, it's highly liquid. You can see that the preferred return goes up as you have more assets under management with us. And then whatever profits are left over after paying out the preferred return and our fees for administration are then divided up among the investors in the fund. As John points out, I believe I have moved my money from an unpredictable market subject to many economic factors and significant risks to a fundamentally sound business model that's a hedge against inflation. I recommend them to my friends and family with confidence. Like Justin, who's been able to transition their hard work as a small business owner into a passive portfolio. Would you like for us to do an investment review for free? Go to irontoncapital.com/review and choose your time, and we'll be able to deep dive with you on your personal view and goals and answer any of your individual questions. Sound good? We have a lot of projects in the works, so our time is limited, so please go ahead and secure your spot now. We can't wait to see how we can help you with your investment goals as our gift to you.